What's good, all my stock market investor and trader homies? It's your boy Kevin. In today's video, we're going to be talking about trading stock options. We're going to be discussing my favorite stock option strategy. It's a strategy where you can make money, you can profit, no matter what direction the stock market is heading. Stories are far and few between, and most people who buy way out of the money options looking to pick the direction of the stock market end up losing money. It's pretty much gambling, but something you can do to make consistent money in the stock market is become the casino. Become the casino and sell options contracts instead of buying them. So you're basically taking these high risk bets from these options traders. You're basically the bookie and they're the gamblers. The house wins every single time. The strategy we're going to be talking about is called selling spreads, vertical spreads, and iron condor. I know it sounds confusing. You might never heard of it before, but it's an awesome strategy. And if you stay tuned till the end, you won't be disappointed. 10 minutes out of your day to learn how to make consistent profits selling options contracts. What's not to like? Before we get started, everybody do me a big favor. Hit the subscribe button if you're new around here. Turn on the notifications. And everybody destroy that like button for me, because the like button is not our friend. I have the SPY chart, the S&P 500 index chart pulled up on the screen, and that's the ticker we're going to be using to do this example, and I'll show you guys the strategy. But before we do that, I have the Webull charts on the screen. It is the broker I use every day. They have an awesome promotion going on. You can get 2 free stocks valued up to $2,000 of free money if you sign up with the link in the description. So check that out after the video's over. So we're going to be walking through this step by step. I'm sure some of you guys have never heard of an iron condor. What the hell is an iron condor? Slow your roll. We're going to be doing this in baby steps, and by the time we're done, you should be able to implement this strategy in your own trading. Most traders think of options trading as just picking the direction of the market. If you think the stock market is going to go up, you buy call options contracts. If you think the market is going to go down, you buy put options contracts. But there are way more complex options trading strategies out there. The first one is selling vertical call options contracts. So let's say you think the market is too extended. Like I personally think the SPY, the S&P 500, the NASDAQ, the Dow are all too extended. But I'm not willing to step in front of this train that we have seen just charging higher. But what I am willing to do is to say that the market is going to be trading under 445 to 3 months from today. What I can do is sell that 445, call it November call option. Let's say the credit for that is $5. That's not going to be accurate, but we're just using it as an example. And then for protection, I can buy the 450 call option, and let's say the debit, because I'm having to buy that, I'm not selling it, is $3. So my net credit on each contract that I buy and sell is going to be $2, because the spread of the two options contract is $5. You minus the $2 credit that you're taking in. So your risk on each options contract is going to be $3 to only make $2. But we have to realize that the probability, the actual probability on this trade is extremely high. We're talking about $5 or $6 on the SPY above where it's trading right now. The odds are probably north of 70% that this trade works out. So sure, you're risking more if you hold till expiration than you are in potential profits, but the odds of this trade working out are way greater than the trade not working out. That's what's great about selling vertical call options contracts. So if the market just chops around for the next couple of months, stays below that 445 area where we sold our call option, we make money. And then if we hold that options till expiration, then we collect the entire credit. Now let's say the market sells off. let's say it sells off under that 445 level and closes on the date of expiration below that 445 strike price, then we keep the entire credit. The only way we lose money is if the stock market on the date of expiration is above that 445 strike. It is an extremely powerful strategy, and you can do the same thing in reverse. If you think the stock market is going to be staying above, we'll call it $430 in the next couple of months or the next 6 months, you can do it with put options as well. So you would sell that put option at 430, and then you would buy a put option at 425, we'll call it, for protection. And the same thing is true in this situation. If the S&P 500 stays above that 440 or 430 strike by the time of expiration, then you keep the entire credit. Here's where things start to get a little bit complicated. The next strategy we're going to be talking about, the final strategy we're going to be discussing in today's video, is called the Iron Condor. The Iron Condor sounds like a superhero, and it almost is a superhero because it's an awesome technique to use. Selling Iron Condors is basically selling a vertical spread, like we talked about earlier, 445, we sold that call option, we bought the 450 call option, but then also selling a put vertical spread as well. Remember, we sold that 430 put option and we bought the 425 put option. Basically, what you're saying when you put on a trade, the Iron Condor, you're saying that you think the market is going to chop around in between the two options that you sold, that call option up here and that put option down here. You think the market, by the time of expiration, is going to be trading in between those two contracts that you sold. Right now, we have seen an uptick in volatility after the sell-off off of those all-time highs in the overall market. The uptick in volatility increases options pricing. It makes it a great time to sell options vertical and Iron Condors. This is not a strategy that you want to use when the market is heading in one direction in a very decisive way. If the market is just chugging higher very slowly, then options are going to be cheap because there's no volatility. We want to be trading the strategy when the volatility is high, but the move that you're expecting doesn't really match up with the expected volatility. So right now, I think everybody's anticipating either a breakout towards new all-time highs or just a complete capitulation and a rollover, and that's not what I'm expecting, making it a great time to put on an Iron Condor trade. So let's jump into the options chain and look at it. The Webull options chain, remember, you can get your free stocks from Webull, link in the description. And I like to go a few months out when I'm putting on a options trade. It just gives the trade more time to work. And one of the biggest mistakes new options traders are going to be making is trying to pick those really near-term options contracts to trade because they're cheaper. They are cheaper, but they're cheaper for a reason, and because that theta or time decay is going to absolutely eat up whatever you put into those options. So I'm going to be looking probably at October or November. November is 90 days away. That gives us about 3 months. And then we go to both up here because we want to see both the call and put option side of things. Remember, we said the 445 call is the contract that we were looking at to sell those call options. So on the left side of the screen, we have the call options 445 November are selling for 11 bucks. The 450s, or we'll call it 449, are selling for 9 bucks. So we're only going to have a credit of about 2 bucks on these calls. But then on the other side, we have the puts. We called it the 430, selling for 12 bucks, and then we would buy down below, so about another $2 credit that we're taking in. So if we go back to the chart, we're taking in a $2 credit from the puts and a $2 credit from the calls, giving us a total credit of $4. And it's not possible to lose money both on the calls that we sold and the puts that we sold. So you're only really risking $3 per contract that you sell. You have a max reward of $4 per contract that you sell. I encourage you guys to do more research on it. I'll leave some good links in the description down below that kind of describe this strategy in detail. Selling vertical spreads and selling iron condors. Become the casino, not the gambler. The house always wins. Only 10% of options contracts are ever exercised. That's an astonishing number. Sure, some are closed out prior to expiration, but most times when you're picking an out of the money contract and you're trying to pick the direction, it's going to end up worthless. That's going to wrap up this video. I hope you got something of value from it. If you did enjoy the video, do me a favor and hit the like button. I'll catch you in the next one. Until next time, peace.